The housing market is crashing. Mortgage rates have surged to an alarming 22-year high, now averaging over 7%. This is the highest they've been since the year 2000. So today, I'll be sharing how this will impact current home buyers. Will the high mortgage rates affect our economy? The surge in mortgage rates has already resulted in a lack of buyers' purchasing power. To give you an idea, increasing the interest rate from 4% to 7% decreases purchasing power by 40%. This tells you just how unaffordable the housing market has gotten. About a year ago, the average monthly payment for a house was $1,187, with an interest rate of 3.18%. The new monthly mortgage payment climbed to a record high of $1,988. This is a monthly increase of $801 a month for a home. That's almost a 70% increase in a family's monthly mortgage payment. With the massive growth in mortgage rates, we can expect havoc in the housing market and the economy. Investors often consider mortgage rates and refinancing activity as the main drivers of housing demand, but real income trends tend to play a larger role. The price-to-income ratio for U.S. real estate now stands at 4.8 times higher than its post-war high, and affordability is at its lowest level since the subprime crisis. With regards to buying a home, consumer confidence is at its lowest level since 1980. But just as demand is being challenged, potential supply, homes that have been started but not completed, is reaching record highs. New home sales beat expectations in August, but data on the same day showed price declines due to a lack of demand. Some experts argue that this volatility could signal that the housing market slowdown could increase the odds of a recession. Now, the effect of this supply and demand imbalance are beginning to emerge. In July, new home sales were down nearly 50% compared to the two previous years. At the same time, this year's National Association of Home Buyers Index fell faster than ever since the pandemic began. Now, while the U.S. fiscal balance sheets remain strong, this has not been a barrier to past recessions. Before previous recessions, they often had strong balance sheets, and consumer confidence in our country's finances has never been worse. In reality, the widening wealth gap in the U.S. is largely what is driving the difference between Main Street consumer sentiment and the numbers on a balance sheet. Okay, let me explain how the Federal Reserve has been propping up the housing market since 2008. The Fed previously would buy hundreds of billions worth of mortgage-backed securities each month to keep interest rates low, and they did this for years, starting well before the previous pandemic. But the Fed suddenly stopped doing this in response to inflation. The Fed will likely even start selling off some of these securities that they've purchased over the last 15 years. In a recent statement, a Bank of America economist downgraded his economic forecast due to a larger than expected contraction in the housing market. The impact of a real estate crash on a broader range of investments can be expected, but the main market risk from the housing cycle lies with non-bank mortgage lenders. They are the main players in financing the recent housing boom since the last housing crash. And if reduced housing prices spill over into commercial real estate, as we have seen it do over the past 70 years, these mortgage lenders would face even more trouble. Now, the U.S. housing market is central to both real economy and financial markets and could be important in the Fed's timing to policy changes. U.S. interest rates typically reverse when the Fed is motivated to provide quantitative easing due to a financial crisis. However, inflation may prevent the Fed from being able to provide the same relief anytime soon. Given the importance of housing construction to the U.S. economy and markets, it may be time for the Federal Reserve and other central banks to follow in the footsteps of the Reserve Bank of New Zealand and explicitly include housing construction in their policy mandates. Now, will a change in the Fed's policy affect mortgage rates? Well, the Fed has two main objectives: price stability and maximum employment. Price stability means that inflation remains low and stable. And when inflation is low and stable, people can hold money without worrying that high inflation will decline their purchasing power. When prices are stable, consumers and businesses don't worry about prices going up or down when making plans, borrowing, or lending. This means that the economy works efficiently when inflation is low and prices are stable. The Federal Reserve aims to achieve a 2% average inflation rate over time. The idea of maximum employment can be viewed as the highest level of employment that an economy can sustain over a long period while maintaining a low and steady inflation rate. Of course, the timely measuring and maintaining of maximum employment is difficult because the level of maximum employment changes over time, depending on business conditions, demographics, labor markets, regulations, and other factors. Now, the Fed does not have some specific target for employment levels. Rather, they use a wide range of data to analyze economic conditions and develop strategies to maximize employment. Just like the conditions we are facing right now, high inflation and lower unemployment can overheat the economy, causing the Fed to introduce tightening or contractionary policies, such as interest rate hikes, to slow economic growth and cool the economy. But when we have low inflation and a high unemployment rate, the Fed could start accommodating expansionary monetary policies to lower interest rates and inject more money into the economy. We can use the 1970s and early 80s as an example. The economy experienced high inflation and high levels of unemployment. The Fed decided to curb inflation by raising interest rates, which really pushed us into 2 consecutive recessions. It took a while, but inflation returned to low, stable levels. Unemployment fell, and the economy recovered. Now, once a new policy is implemented, it usually takes several weeks or months to see its impact on the economy. Even the Fed can't predict exactly how the economy will react to each change, so their plans often change based on new data. So the Fed might say they plan on keeping interest rates high until the end of 2023. But predictions like that don't mean much, even coming from the Fed. A shift in economic fundamentals could easily force the Fed to reassess its position and decide to change course. This could be disruptive in the short term as market expectations and business forecasts are revised in light of the new policies. The Fed currently has a target inflation rate of 2% annually and seeks to maintain maximum employment. And to fulfill its dual mandates, Fed shapes its monetary policy according to the state of the economy. And this includes setting the federal funds rate, or short-term interest rates, at which commercial banks borrow and lend money. If the economy is expanding, the Fed can raise interest rates. And if the economy is contracting, the Fed can cut interest rates to keep them low. That makes it sound like the Fed has a solution for everything, right? But a change in Fed policy might not always work. The Federal Reserve may pivot in response to a changing economy and may not always be able to maintain price stability. Critics argue that the Fed's decision may be lagging because they are retrospective. They can't effectively anticipate changes in the economy. Some argue that Fed policy changes often don't last very long, as when the Fed eased its aggressive tightening early in the 1970s, paving the way for stagflation. Now, can we predict when the Fed will start lowering the interest rate? Well, in recent decades, the Fed has significantly improved its transparency with regards to communicating its intentions. But the exact timing for the Fed to change course remains a matter of an educated guess. Some people anticipate that the Fed will start lowering interest rates once we hit a 5% unemployment and 5% year-over-year inflation. The futures and options markets can be used to confirm the market's implied opinion regarding future rate hikes or cuts. Now, the Federal Reserve officials have hiked interest rates 5 times this year to cool the economy and bring inflation down from a 40-year high. Many market observers ironically hope for signs of a weakening economy. However, the stock market has seen a recent bounce. But will the Fed reverse course and start lowering interest rates? This bad news turned good news momentum came on Monday after the manufacturing data from the Institute for Supply Management showed that U.S. manufacturing activity grew at its slowest pace in more than 2 years in September. Because of that and other recession warning signs, investors believe that a change in Fed's policy may come sooner than later. Amid signs that U.S. economy growth may finally slow, investors in the futures market now expect the federal funds rate to peak around 4.5% next year, compared to the expected peak of about 4.7% they priced in last week. But in a speech at Northwestern University Policy Institute, the Atlanta Federal Reserve chairman made it clear that a change was nowhere in sight, reversing the market rally. Now, the market has bounced several times this year in hopes of a Fed turnaround, but has tended to reverse and fall to new lows, leaving investors wary of the current rallies. But recently, a series of weaker than expected U.S. manufacturing and employment data are among the factors fueling hopes that weaker growth will prevent or delay the Fed's rate hikes. Meanwhile, analysts at Capital Economics wrote on Tuesday that signs of a labor market slowdown highlighted in JOLTS data might not be enough to reassure the Fed to pause the pace of rate hikes. They also said that the data doesn't preclude more aggressive rate hikes in the near term, but it does support our view that inflation will fall faster than Fed officially expected. Investors are desperate for signs of a Federal Reserve pivot, and the United States housing market could be more important than inflation and unemployment in forcing the Fed to ease. Go ahead and watch this video about how current oil prices are affecting the economy. Make sure to hit that like button and subscribe, and you guys have a great day.